Welcome, everybody. Today we're going to be talking about RSUs, RSUs, ISOs, NSOs, making sure that you don't have an IOU to the IRS. Today I've got Julie Merrill here. She's a CPA with over 25 years experience. She works with business owners, high net worth individuals, doing tax strategy. Um, she's based out of California right now, and she's hoping to make that move, I think, to Tennessee here shortly. Julie, how are you? And thank you for hopping on today.
I'm good. Thanks for having me on. Excited to talk about RSUs. They've become really popular, and there's definitely some good tips that we want to share out there. So thanks for having me on today.
Yep, and y'all be sure to stick around. Julie has created a checklist that we'll be dropping later on in the episode for you to go to, sign up, see kind of things that you need if you do have these issues. So, first up, Julie, just tell everybody what is an RSU.
Right. I mean, so RSUs, right, we as accountants, we use all these acronyms. If you've received an RSU, you probably are very familiar with it, but it's a form of equity compensation. So it's a restricted stock unit. Anytime you get any kind of equity compensation, and there's various kinds, Anthony just kind of mentioned some of those types, you definitely want to be in the know of what the tax effect of your action and your inaction is going to be. And so today I'm excited to share some tips about RSUs, and we'll talk about some of the other different types of equity compensations briefly, but focus on RSUs today because it is super popular, and I'm seeing lots of big businesses using it as a form of kind of rewarding their employees in a way that doesn't involve necessarily like giving them a bonus, a cash bonus, maybe that they have done in the past.
Yeah, they are becoming more and more common, especially I think in the tech industry. Some of my oil and gas companies, I've heard too. Before we go into, again, just the tax treatment of RSUs, what are some other types of options that employees might be getting besides RSUs that they should look out for too?
Sure. So, more generally in like startup companies, we see stock options where you have the option to buy company stock, typically at a discount. And there's qualified and non-qualified versions of those, and those are treated very differently than what we're talking about today, which is the RSUs. You might even hear RSAs. Well, that sounds like an RSU. Again, we're going into acronyms that we can dive deeper in today, but it is different, right? And so knowing what you receive, I guess as a tax preparer, a lot of times I get clients that come to me and they have RSUs, but when we start asking for the documentation, we find out they have other forms of equity compensation as well. And another one is an employee stock purchase plan, an ESPP, where you can buy a company stock at a discount. And sometimes we have a mix of all these different types of equity comps, and because they're treated differently from a tax perspective, it almost becomes like a puzzle to figure out what the employee has so that we can then address the tax treatment and the tax plan on how we're going to approach that so we can save taxes as well along the way.
Yeah, and how is someone supposed to figure this out? Does TurboTax tell you what you have? Or
uh, Unfortunately, TurboTax is great if you just have a W-2, you're a simple return. When you start getting equity compensation or stock options, it is really not a time to self-prepare. I correct misfiled TurboTax returns with stock options on the regular. And there's definitely things that, like, I see a return and it pops out at me. If I see any kind of stock sale with a zero cost basis, it's like a big red flag goes up on me. And usually that's something we can go back and amend and save clients quite a bit of taxes on. So yeah, when you're starting to get equity compensation, it's time to hire an expert. And the more you involve them early on in the process, as you get the grants, as the awards are vested, as you decide to exercise, you will be, your future self will thank you
yeah,
because your tax saving starts proactively and knowing kind of what's coming will make you help the decision on whether you exercise or not on certain types of equity grants.
Yeah, I agree completely. And I tell all of my clients and anyone, prospective clients too, tax planning is all about being proactive. If you're waiting till April 15th or, once you've already got these things, you're being reactive and you're probably missing out. So, that kind of segues us right into tax treatment of RSUs and, what how are RSUs taxed? First off, are we getting taxed at ordinary rates or is it capital gains? Or is it kind of a mixture of both and it depends on what? So can you go into kind of tax treatment on RSUs
Sure.
and maybe the timeline?
Sure. So RSUs are an award. So unlike other type of equity compensation where the employee has to pay something to purchase that or exercise that type of option or even discount to buy the stock, an RSU is typically rewarded to you for some kind of performance. Either through it's granted with a time component tied to it where you earn it over time, or some type of event or performance measure that makes you then get that grant vested. So vested is a term that we're going to use across the board for all types of equity compensation. When something vests, it's earned. And so generally that's when we're really treating things as when you're earning something. Usually it's a taxable event in most cases. With RSUs, we don't have to purchase it. It is when it vests, meaning the employee has earned it, has reached that time component or that measurable event, and it becomes them. It's treated a little bit differently than maybe some of the other types of equity compensation. Since there's no price to it, the employee does nothing, but it shows up on your W-2 and it becomes ordinary income taxed at your ordinary income tax rate. You'll see that the value of that RSU at the date that it vests showing up as income. You're going to have payroll taxes withheld on it. And because you don't have cash yet, you haven't sold that stock that's going to come to you. Typically what companies do is they either withhold to cover the taxes or they sell to cover the taxes. So let me give you an example. Let's say you got 115 RSUs granted to you and they're vesting on January 15th. So on January 15th, the company will look at what the market value is of that. It's going to show up as income to you as the employee, and they're going to typically withhold 22% for federal and some tax for state, depending on the state tax, if there's taxes involved. So they'll sell to cover or withhold to cover. So in this example, let's just say they withhold 15 of those units. So you started out with a grant of 115. They withhold 15 that they basically liquidate to withhold taxes for you. And then they transfer the net difference, the 100, to you to some type of brokerage where now you can actually sell those stock. So now they're yours, but the tax withholding has been somewhat taken care of for you. Now, 22% is the standard that most companies withhold unless you get to a certain, I think it's $1 million and then it goes up higher. But what happens is you might be like, oh, I'm covered because 22% is going to be good for me on my tax return. But because you're receiving this grant, now your income's shooting up. And so most likely you're going to be in a higher tax bracket. And so 22% might not be enough withholding. And because they didn't withhold enough for you, when you go to file your taxes at the end of the year, you might have a surprise tax bill. And especially in executives who are high earners, who are earning, upwards of 500 to $1 million in their W-2s, you're in the 37% tax bracket, and you possibly only had 22% withheld on this equity compensation. So being involved with like a tax advisor can help you prepare for that. So we can make some estimated taxes or plan for that, maybe do some tax planning where we can offset that tax or that income in different ways on your tax return before the end of the tax year. So that's ordinary income. So when it vests, we've got ordinary income, and that is one piece and one component of the RSU that you need to think about. Once you have that issued to you, oops, sorry about that. Once you have that issued to you and it shows up on your W-2, that's your cost basis. So now you have a stock in a brokerage, you have, let's go back to the same example. We have 100 shares of that company stock now in a brokerage where we can sell it. Now we are subject to capital gains. So whatever we sell above that cost basis, if the price goes up, we're going to have a capital gain. And if we don't hold it for more than a year, it's going to be taxed at short-term capital gain rates versus holding that stock for a year and then being subject to a lower tax rate at long-term capital gain rates. So many times we're having discussions, or I'm having discussions with my clients who are getting RSUs, and we're talking about, what do you project is going to happen with the price? Because if the price goes down, it's still better to pay, right? You're not going to have capital gains. You might want to liquidate it before it goes too low. And then you have this loss, basically, because you sell it for a lesser price than what it was issued to you. So two components, the ordinary income tax is when it's vested and you earn it. And then when you sell it, you might have capital gains as well. So two different types of tax that we need to think about when we get RSUs. Do you want me to talk about just some of the mistakes I see?
Yeah, I think we can go into that next. I just want to maybe clarify, right?
Sure.
So when you're actually awarded the RSUs, you're not actually taxed until it vests. Is
Right.
that
So,
right?
so just going back to some terminology, you might be granted on RSU. It's a restricted stock unit. It's not a stock share until whatever stipulation is tied to that grant takes place. And typically that's either some kind of time, it might be 12 months, or it could be that you've reached some type of milestone or, some kind of KPI that the company's reached that triggers that to be vested. So at grant, it's not yours, right? If you were to leave the company, that goes away because you haven't earned it. So vesting is kind of the key trigger that creates the first taxable event in RSUs.
Yep. So we got that timeline. Once your RSU vests, you got an ordinary income trigger event that shows up on your W-2.
It does. And so
And
you'll see, you'll see it. It should be in a couple places on your W-2, but you'll definitely see it hit your compensation. Box one if we're getting technical from a tax perspective.
can people adjust their W-9? Do you generally recommend that if we're in a higher bracket, or do you just recommend kind of looking at your situation and maybe paying the withholding outside of that 22% that's typical?
Generally, they won't withhold more than that. 22% is just going to be taken care of for you by the company, and that's a requirement. So companies are withholding and selling enough shares to cover that 22%. Now, this part of your income, your W-2 is just one piece of the puzzle that goes into your year-end tax return. So you could have some other tax credits or tax deductions that are going to offset some of this income. And especially if you're working with an advisor who's getting, involved with this early on, which I always recommend if, with RSUs, you're out of control because it vests when it vests. But in many type of equity compensation, when we're kind of pulling that trigger to exercise it or for it to become ours and it triggers a taxable event, it's always better to do it early in the tax year. So we're talking, first quarter of the year, because now we have time to look at different opportunities where we might be able to do certain actions that offset that taxable income with maybe a deduction or a tax credit that is much more difficult to do if we're talking in December.
Yeah,
Or,
yeah,
or and maybe even completely not an option if we're talking in April of the next year when we're filing a tax return.
yeah, definitely. So we got that ordinary, and then it just depends on how long you hold.
Yeah, for RSUs, it's just the normal year where, based on when you, get the stock yourself, right? When it vests, if you hold it for a year, longer than a year, then you have the long-term capital gain rate. Some of the other stock options have different timelines, or stock equity compensation. So that's something to note. But specifically for RSUs, it's a year from when it vests and it becomes yours, just like any other stock would be if you were selling it.
Great. That's good to know. And so before we go on to common mistakes, I was just curious on, we're talking about W-2 income earners here. What kind of things, we don't have to go into exact nuances of strategies, but what kind of strategies can people potentially look at to take advantage of, to offset this ordinary income that they might get?
Those are things that sometimes it's customized based on the person, and that's why we want to get in front of someone with an advisor. I know with you, Anthony, and with me, we're part of like Mark Kohler's network where we have this whole kind of, I call it my toolbox of tax saving strategies that are available to people. There's less with just W-2 earners, but maybe you have a spouse that owns a business, and that kind of opens up, the can of worms, if you will, to different opportunities we have to save on taxes. I'm not saying there aren't tax saving strategies. There's definitely a big one that always comes up is charitable deductions, right? And whether you itemize or not. I have maybe some instances where clients were looking at donor advised funds, or maybe some even other charitable strategies that we discuss one-on-one basis, that might come with some different risk possibilities as well. So more customized, definitely, tax credits, right? Like if we're talking about buying, most of the time if you're getting an RSU, you're not going to qualify as a taxpayer now for an EV tax credit because your income's too high. But if you're putting solar on your house, you're going to get, a 30% tax credit. That's going to come off your tax bill, and can be a big hit if you're strategic about it in the same year that you have a big taxable event where you have more income coming in.
Yeah, layering those strategies and credits could, something a lot of people ask me about. Could people do short-term rentals? Would that offset this type of gain if they
If they
qualify?
qualify. That's one of those areas where I got requests and I'm like, okay, well, let's sit down and make sure we've got it's highly audited, right? So we want to make sure that they have not just the strategy in place, but the documentation to support it, and making sure that they're documenting their hours, and we really have a proactive tax plan in place to make sure that we're not getting close to the tax year, into the tax year, or after the tax year, and maybe we're short some hours or short a real thorough understanding of how to implement this and be above board. At least with my clients, I love to find tax strategies for them to help save money, but I also want to set them up for success and make sure that everything they have in their place documents the deduction that they're taking, right? So if there's ever a future audit, they have that kind of in their back pocket, to support why they're taking that tax deduction.
Yeah, and that's really the benefit of working with a tax strategist and someone who's got a license on the lines too. On the line is anyone can take a deduction. You can take any position in a tax
Right.
return. It's whether it's going to stand up in the audit.
Right.
Uh, so
You don't need it until you need it. And then you're like, really need it.
well, that's good to know. And, again, I think the importance is being proactive, speaking with someone, getting someone on your team so you can plan around that. So, what are some common mistakes you see
Sure.
with RSUs, and what are people making?
So going back to your TurboTax comment, right? If I see a TurboTax return come through and I see a zero cost basis on some company stock, it's a big red flag that goes off in my mind, because while you as the employee didn't pay cash for that RSU, you declared it as income as soon as it hit your W-2 and your paycheck. So as a tax preparer, we have to adjust the cost basis on the tax return for what you've already paid taxes on through payroll. And that's a common, do it yourself big mistake that I see on someone who self prepares. Unfortunately, I even see it sometimes on preparers who will do a return and aren't maybe as familiar with these type of compensations and the tax effects. And so we're adjusting that cost, because if you don't, you pay tax on it through payroll, and then you're going to pay tax on the same compensation again on your tax return, and you're paying double. And so we want to make sure that the right cost flows through. And unfortunately, when we get, as a tax preparer, if we get a brokerage statement, many times they come through and they say, you've got your sale proceeds at a certain dollar amount and the cost is zero. So as in my position, the first thing I'm asking for from the taxpayer is the supplement. So many of the different brokerages now will come out with a supplement, and especially like E-Trade, Morgan Stanley, their supplements are really great now. A couple years ago, they weren't so great. Now they're tying out and showing that adjusted cost basis. So they're already accounting for it. So we're not double paying the tax on that same stock. While it
Whose
seems
whose burden is it to show the basis? Is it the IRS, or is it on the
the
taxpayer?
IRS is not going to give you any favors. If you don't file it correctly, they're going to take their money. And so it really comes down to the taxpayer. And that's why understanding how these work is so critical, because even if, you know, I call myself, I'm not your grandfather's CPA, right? Because I am not just churning out tax returns. I want you to be in the know, and I want to be more advisory all throughout the process. And I know you are too. But if you just wait until April, or even like file an extension, you're sitting in an office in September, you just don't have maybe the exposure, or even someone who is maybe well versed on all these different new equity compensations, or maybe more popular ones, and how to treat it. And unfortunately, I see mistakes because of it. So the brokerage statement, the supplement is huge. I also ask for all the grant documents because I want to tie those out. While it seems pretty straightforward, like the example I gave, you got 115 RSUs, they withheld 15, you got 100, and then you sell it. Pretty straightforward, right? But what happens is I'll get a stock, we'll have, 15 different grants, and maybe we have some RSUs in there, and I'll look and be like, oh, hey, you have some non-qualified stock options in here, and you have some ESPPs, and they're all traded a little bit differently. And then you get a brokerage statement where you've got like 100 transactions of, you sold 7 units, you sold 15 units. And now we're trying to kind of map, if you will, the stock that was sold on each line item with the grant to make sure that the cost for that transaction is correct. Gets a little tricky. The more activity you have, the trickier it is. And so that's why getting these supplements is so key. And again, some of the brokerages are way better in their supplements than others, because we want to make sure we're, it's not like a first in, first out where you get to just sell any of them. It is truly like this stock grant is tied to this transaction, and they're not going to probably match. You're probably not going to get 100 and sell 100.
Yeah. So, I mean, what I'm hearing is substantiation, like any deduction you're going to take, or any tax position you're going to take, is very, very important, and keeping track of it all too. So,
Right. So I even have my own like kind of internal spreadsheets I've created so I can track it. So even if I get someone who gets grants invested throughout the year, but say they didn't sell anything, I'm still collecting that. So I have a record on my end. So when they do sell it, I can map it back. Unfortunately, there are times when it gets a little bit tricky and it's not straightforward on the supplement, or as many times as we ask, clients say, I didn't get a supplement, right? And so now we're having to kind of do that work to tie everything out.
and let's say that for whatever reason, they can't get the supplement, or they can't find their grant documents. What's the best advice, or the best way to track that down? Is your employer responsible for keeping all
Yeah,
of
I mean,
them?
you got to go through the employer and contact them. They have some kind of record that they can give you copies of if you didn't save it. Documentation is your friend. It can be your best friend. And so if you're receiving these type of compensations, you want to make sure you're putting it in a safe place. And if you've lost it or misplaced it, go back and ask.
And I think with that, Julie, that kind of segues into, you put together some tips and kind of a checklist or something. Can you tell us about that and where to
Sure.
find that?
Sure. I just created a little maybe an ebook is an overstatement, but just a little PDF that you can download that has the essentials behind RSUs. It talks about what it is, maybe some different triggers that we've talked about in events, and the tax treatment of it. And you can get it at rsutips.com.
Yeah, that's rsutips.com. We'll put that in the show notes too. Moving forward, I guess, what's some key advice for everybody out there who, knows that they're getting something, but not exactly sure what they're getting? Or maybe they know they're getting some RSUs, but haven't talked to a CPA.
Sure. So keep your documents, right? That's just, even if you're not familiar with it, your tax advisor will be, and they're going to be asking for it. And like Anthony said, it's going to support your documents. It will help you avoid paying double tax in the situation where I mentioned where like a cost wasn't adjusted, just because we're missing the documents, right? And we don't have the paperwork to support it. So having a good relationship with your tax provider, your tax preparer, your advisor, and being proactive is going to help you maybe have a better strategy to pay less tax in the long term. But we definitely don't want you to pay double tax. So keeping your documents and maybe like just learning about it, right? Just learning a little bit more about what you're getting. In the guide, I kind of have some basics and just definitions in there, just to be more knowledgeable about it. You don't know what you don't know, right? So we want you to be in the know. So we don't want you to pay any more tax than you have to. And unfortunately, when you don't put the time in advance, that's what happens.
Yeah.
Or can happen.
Yeah. Don't you have some videos too on RSUs and these different employee awards on your YouTube as well that people can
I
check out?
do. I have a YouTube channel, and I can give you the link. It's my, I guess my handle is Julie Merrill CPA on YouTube. My channel is called Profit Above Board, and I have a blog too with a bunch of articles that are kind of go back and forth. It's also profitaboveboard.com.
Yeah, y'all go check out her channel and page too, and her blog too. She does a really good job at that. Where can people find you? What's your website? And everyone, right now we're kicking off into tax time. Julie, people are booking her up for tax strategy. So you guys, if you are looking for tax strategist, Julie, where can people go and find you?
So my website is juliemerrill.me. It's Merrill like Merrill Lynch, Merrill, not Merrill like the shoe. Someone has juliemerrill.com, and I've tried to buy it like 20 times, and it goes to a dead website. But
I
yes,
just bought anthonybrister.com.
yeah, you got to buy those, right? I've bought them for my kids' names too, right? And it just, so you got to lock those in. But yeah, I've made offers on juliemerrill.com multiple times, and it goes to like just, it goes nowhere land. So yes, my website is juliemerrill.me. And I have resources on there as well. I have some freebies. This RSU guidelines also on there on my homepage, and links to my blog and all of that.
Yeah. Well, thank you for being on. Everyone, I hope this was helpful. Maybe you learned something about RSUs. Reach out to Julie. Go to her page. Go follow her. Reach out to her website. She's doing really, really great work with tax strategy. And if you want to keep more of your hard-earned money, go look her up. So thank you guys for listening to the Wealth Planning Podcast with Brister Law. I'm Anthony Brister, and we had Julie Merrill here. Y'all enjoy it. Don't forget to like, subscribe, and follow.